Jake bought a rental property. Marcus bought an index fund. Same 50 grand out the door. Same salary, same city, same starting line, same day. Fast forward 20 years, and one of these guys is sitting on a whole lot more money than the other one. And I'm telling you right now, it's not the answer your landlord buddy is hollering about over the grill at the family barbecue. See, one of these men forgot to count the hours. The other one forgot to count the zeros. So today, we're running it all. Every number, every repair, every vacancy, every 3 a.m. phone call about a busted water heater. And we're going to find out who actually walks away the winner. Jake buys a rental property. Marcus puts the exact same money into index funds. Both of them walk away convinced they made the smarter move. Both of them are wrong. Because one forgot to count the hours, and the other forgot to count the zeros. And when you actually run the numbers across 20 years, the gap is going to drop your stomach through the floor. Let's keep this fair. Jake and Marcus each have $50,000 saved. They each pull down $55,000 a year. Same age, same city, same starting line. The only thing that separates them is what they do with that 50 grand. Jake puts his down as a 20% payment on a $250,000 rental, a modest 3-bedroom house in a decent neighborhood, 30-year mortgage at 7%. His payment lands around $1,330 a month. He finds a tenant happy to pay $1,800. On paper, that's $470 a month in profit before he's spent a single dollar on anything else. Jake feels like a genius. Marcus takes his $50,000 and drops it into a total stock market index fund. No leverage, no tenants, no keys to hand anybody. He sets up an automatic $300 a month and never thinks about it again. His coworkers ask what he's investing in. He says index funds. They nod politely and change the subject. Nobody's impressed. Day 1. Jake has a house, a tenant, and a story for dinner parties. Marcus has a brokerage account and a confirmation email. It isn't even close in terms of how it feels. But feelings and math are two very different animals. The first few years, Jake is living the landlord dream. Rent hits his account on the first of every month, like clockwork. He drives past the place on his way to work and thinks, I own that. He's writing off mortgage interest and depreciation, shaving a couple thousand off his tax bill every year. He's building equity with every payment he makes. He's watching comparable homes on that street tick up in value. Every single piece of this feels real, tangible, and smart. Marcus? He logs into his brokerage once a quarter. The number goes up a little, then down a little, then up a little more. Year 1, his $50,000 becomes about $55. Year 2, maybe $61. It doesn't feel like anything is happening at all. No key in his pocket, no tenant texting him, nothing he can point at from the car window, just a number on a screen. Jake's friends ask him about the property. Marcus's friends don't ask him about anything. The social proof alone has Jake feeling like he's winning by a mile. Now let's run the numbers through year 3. Jake has collected roughly $64,800 in rent. His mortgage payments total about $47,880. That leaves $16,920 in gross cash flow. Sounds beautiful, right up until you start subtracting. Property taxes, about $3,000 a year. Insurance, another $1,500. He's already swapped out a water heater for $1,200, patched a leaking roof for $2,800, and eaten 1 month of vacancy between tenants that cost him $1,800 in lost rent, plus $600 to clean the place and get it relisted. Property management? Jake handles it himself to save the money, which means phone calls at 10 at night, weekend showings, and coordinating contractors on his lunch break. Once every real cost is in, Jake's actual net cash flow across 3 years lands somewhere around $2,000 to $4,000, not the $16,920 that looks so good on a napkin. And that's before we count a single hour of his time. Marcus, meanwhile, has $50,000 in, plus $10,800 in monthly contributions, compounding at roughly 10% average annual return. His portfolio is sitting right around $76,000. Hours spent managing it? 0. Phone calls? 0. Emergencies? 0. But don't count Jake out. because Jake still has leverage doing work for him. That $250,000 property has been climbing maybe 3 to 4% a year, and today it's worth somewhere around $270,000 to $280,000. His equity, meaning the gap between what the house is worth and what he still owes the bank, has grown to roughly $55,000 to $65,000. That's real wealth, and part of it was built with the bank's money, not his. That's leverage. And that's the one edge a stock investor can't easily copy. Now, the rent check. That's the number everybody loves to talk about. It's the number on the YouTube thumbnail. It's the number at the real estate meetup. It's the number your landlord buddy is bragging about over ribs at the barbecue. What nobody mentions is everything that gets pulled out of that rent check before a single dollar lands in your pocket. Vacancy. The average rental sits empty about 1 month a year. That's not a catastrophe, but it is a full mortgage payment with nothing coming in to cover it. And when a tenant moves out, you're paying for cleaning, small repairs, listing fees, and your own hours spent screening applicants and showing the place. Maintenance and repairs. The rule of thumb is to budget 1 to 2% of the property's value every year. On a $250,000 house, that's $2,500 to $5,000 a year. Some years, it's a $200 faucet. Other years, it's a $7,000 HVAC replacement you never saw coming and can't put off because it's August and your tenant is already talking about leaving. Capital expenditures. Roofs last 20 to 25 years. Furnaces, 15 to 20. Water heaters, 10 to 12. These aren't maybes, these are guaranteed future bills, and they show up in chunks of $5,000 to $15,000. If you're not tucking money away every single month for that, you're not running a business, you're running on luck. Property management. If Jake hires a manager, 8 to 10% of the rent is gone the second it hits. Call it $150 to $180 a month. If he manages it himself, congratulations, he's got a part-time job nobody's paying him for. Either way, somebody pays. And then there's the risk nobody wants to bring up. Bad tenants. A tenant who stops paying and knows exactly how the eviction process works can cost you 3 to 6 months of lost rent plus legal fees. One tenant, one event. That can wipe out an entire year of profit, sometimes more. None of that shows up in the $470 a month cash flow number, but it shows up eventually. By year 5, Jake is living the full landlord experience. He's on his 3rd tenant. He's replaced the roof for $8,500, handled the plumbing emergency that ran him $1,400, and eaten 1 month of vacancy between tenants. He's bumped the rent to $1,950, which helps, but his property taxes and insurance climbed too. His actual cash-on-cash return, meaning the money he actually pockets compared to the money he put in, is sitting somewhere around 3 to 5% once you count every real expense. That's not bad, but it's nowhere near the 15 to 20% he was quoting his friends at that barbecue. Meanwhile, Marcus is still doing absolutely nothing. His portfolio has climbed from $50,000 to roughly $135,000 to $150,000 by year 7, including those $300 monthly contributions. He didn't pick stocks, he didn't time the market, he didn't do one single thing except leave it alone. And now the compounding is picking up speed. The gains on his gains are creating more new wealth each year than the money he's actually putting in. Here's what's really going on under the surface. Jake's wealth is growing, but it's crawling once expenses take their cut, and it demands his attention every step of the way. Marcus's wealth is growing on a curve, slowly at first, then faster and faster. Compounding is boring for the first 5 years, and flat-out astonishing for the next 15. By year 10, Jake's property is worth somewhere around $335,000 to $350,000. His remaining mortgage balance sits at about $166,000. Do the math, and his equity lands around $170,000 to $184,000. Over those 10 years, once you subtract every real cost, and I mean everyone, mortgage interest, taxes, insurance, repairs, vacancy, capital expenditures, Jake's total out-of-pocket beyond that original down payment is somewhere between $20,000 and $35,000. Now Marcus. Same 10 years, steady $300 a month going in, roughly 10% average annual returns, and his portfolio is sitting at about $165,000 to $180,000. He put in $50,000 up front, plus $36,000 in contributions. That's $86,000 total. Everything above that is pure compound growth, and he spent exactly 0 weekends fixing anything. So at year 10, these two are surprisingly close in total wealth. Jake might be a nose ahead thanks to leverage. But here's the thing. Jake also burned hundreds of hours managing that property, took on hundreds of thousands in debt, and parked his entire investment in one asset, in one zip code. Marcus spread his money across thousands of companies and never lost a single night of sleep. Year 20 is where this story really splits apart. Jake's property is now worth roughly $450,000 to $500,000. The mortgage is either gone or just about gone. His equity lands somewhere between $400,000 and $500,000, depending on how appreciation treated him. He's been collecting rent the whole way, sure, but after 20 years of maintenance, repairs, turnover, taxes, insurance, and at least one major renovation, his total net profit from cash flow might be $40,000 to $80,000 above what he actually spent. Maybe more in a hot market, maybe less in a flat one. Meanwhile, Marcus, 10% average annual return, still that $300 a month. His original $50,000 has grown to somewhere around $420,000 to $460,000. Total contributions over 20 years? $122,000. The other $300,000 and change is pure compounding. No debt, no tenants, no 2 in the morning phone calls about a busted pipe. Line up the net worth and they're in the same ballpark, roughly $400,000 to $500,000 apiece. But how they got there? 2 completely different lives. Jake worked for his. Marcus waited for his. Jake carried stress, risk piled into one place, and money he couldn't touch. Marcus carried volatility, but he also had liquidity and freedom. And here's the part that flips the math wide open. If Marcus bumped his monthly contribution by just $200, taking him to $500 a month, his 20-year portfolio jumps to roughly $550,000 to $600,000. That's the magic in the market. Add a little more to your contribution, and compounding multiplies it for you. In real estate, adding to your investment usually means buying another property, signing another mortgage, and doubling your workload. Now, if I only showed you the ugly side of real estate, I'd be doing exactly what every stock market influencer does. So let's be straight. Stocks carry real risks that folks love to breeze right past. Volatility is brutal. In 2008, the market dropped about 37%. March 2020, it fell 34% in a single month. Picture Marcus with $150,000 in that portfolio, watching it slide to $95,000 in a matter of weeks. That's not just a number on a screen, that's gut-wrenching. And the data doesn't lie. Most retail investors panic sell during the crash and buy back in after the recovery, locking in their losses at the worst possible moment. And there's no cash flow. Unlike a rental property, index funds don't mail you a monthly check you can actually spend. Dividends exist. But on a total market fund, you're looking at maybe 1.5 to 2% in yield. On $150,000, that's about $200 a month. $200. That's not replacing anybody's income. And there's no leverage in it either. Marcus put up $50,000 to control $50,000 in assets. Jake put up $50,000 to control $250,000 in assets. That 5-to-1 leverage? That's powerful when property values climb. And it's the #1 reason real estate has minted more millionaires than the stock market in survey after survey. Then there's no tax magic on the stock side, nothing like depreciation. A real estate investor gets to write off the theoretical decline in the value of that building against their taxable income, while the property is actually going up in value. Sit with that for a second. It's a legal tax shelter, and stock investors just don't get a key to that door. Real estate wins, and it wins in situations you can name and identify. If you're in a market where the rent-to-price ratio is strong, meaning the monthly rent is at least 0.8 to 1% of what you paid, the cash flow math is working for you from day one. If you're willing to treat it like a business instead of a side hustle, screening tenants carefully, setting money aside for capital expenditures, building real systems, the returns can absolutely beat stocks, especially once leverage kicks in. If you house hack, live in one unit and rent out the others, you can knock your own housing cost down to damn near zero while you're stacking equity. The stock market can't do that for you. Not ever. And if you understand 1031 exchanges, where you defer capital gains taxes by rolling your profits straight into the next property, you can grow a portfolio tax-free in a way stock investors can't touch without a retirement account. So real estate isn't a bad investment. It's a misunderstood one. And here's the thing about Jake and Marcus. They both walked away from that decision feeling like they'd made the smart play. Jake was convinced real estate was the proven path to wealth. Marcus was convinced the market would just do the work for him while he slept. And neither one of them ever sat down and mapped out what this actually costs. In dollars, in time, in stress, in risk. Stretch that out over 10 years, 20 years, and you see it. The real trap isn't real estate. It isn't stocks either. The real trap is picking one because of a YouTube headline, a podcast clip, or something your uncle said with a plate in his hand at Thanksgiving, and never running the full numbers for your own life. Now, if you're sitting there wondering what happens when you do both, when you own property and you're in the market at the same time, that's a whole different conversation. And the math on that might flip everything you think you know. But for now, next time somebody tells you real estate always wins or the stock market always wins, hit them with one question. Did you include everything? Because the answer that includes everything is the only answer that matters.